Well, we've had a period of flows and performance of risky assets versus safe havens, which has been unprecedented. So the last 12 months have had some of the best ever inflows into global equities, and asset classes such as gold, treasuries, and the VIX volatility have way underwhelmed. We think that divergence is probably going to start to narrow again because the dollar is beginning to firm as rate expectations are brought forward. We're also seeing, of course, a very flattish yield curve, which is not necessarily terribly good for a long-term growth outlook. And last but not least, the positioning in assets, particularly in equities, has been extremely strong or positive. And that in itself is a worry because when everyone is doing the same thing, you tend to have some sort of mean reversion. So from our base case going into first quarter of next year is that we're going to have a period of significant change in asset price volatility led by a firming in the dollar.
Before we even get to 2022, is it possible, therefore, that we're not going to even get our Santa Claus rally this year, Sean?
Well, so far, actually, that has played out in equity markets. I mean, seasonally, fourth quarter is a generous period of time for equities and risky assets. The reality is, though, that everyone is well immersed in the story, and my fear is that you only have to have small changes in expectations of growth or indeed policy tightening, and you could have quite a significant change in sentiment. Bear in mind that over the last 2 months, you've had uncomfortably high inflation readers from emerging markets through to China, through to the UK and the US, but also you've had an acceleration in rate tightening and also rate expectations. So these two are on a collision course, which I suspect is not necessarily going to mean a very happy, maybe not a happy ending for fourth quarter, but a pretty difficult time for first quarter 2022.